This is Joel Solomon introducing the Markets PowerPoint presentation. It's very important that we all understand the power of compound interest and having a long-term focus for accumulating assets for retirement. If you invested $1 million and if you were able to earn 6.9% every year, now we all know that that's virtually impossible. But for example purposes, to show the power of compound interest, especially without taxation, that's what we're going to assume. So with a 6.9% rate of interest on $1 million in year one, we would earn $69,000. If the IRS said no tax, we'd have $1,069,000 going into year two. Same 6.9% interest. Now our interest credit has gone up to $74,000. 6.9% every year for the next 9 years. So in year 10, we're still going to get 6.9, but it's being paid on $1.8 million. So our interest credit has gone from $69,000 in year one to almost $126,000 in year two. This creates an effective yield of 12.58%, effective yield. It's a fraction where the numerator is the amount of interest earned during the year divided by the original invested capital. So $125,000 earned during year 10 divided by my million of original invested capital delivers a 12.58% effective yield. So my nominal rate of interest was 6.9, what I actually earned during the year, but effectively I earned 12.58. Now if we did this every year for the next 10 years, and again in year 20 earned 6.9, my interest credit in year 20 alone would be $245,000. Creating an effective yield of 24.51%. So allowing compound interest without taxation to work over long periods of time can create effective yields that are quite sizable. Now, so how do we get 6.9% and how do we get it to grow tax-free? And how likely is a 6.9% nominal rate of interest? Well, to really talk about that, let's review the relationship between a certificate of deposit at the bank, bonds, and equities, because there is a relationship between the three. So if you were to tell me that you think a one-year CD will pay 1% next year, investment-grade bonds should yield about 2 to 3% more, because if they didn't, why would anybody take their money out of the bank and buy a bond? So, and the other side of that is you will get back your original invested capital in a bond, assuming that the issuing company of the bond does not default. So the relationship in yield between investment-grade bonds and CDs is typically an investment-grade bond yielding 2 to 3% more. Now to give up your semi-annual interest payment on the bonds and go into equities, like let's say the broad market S&P 500, you've got to have an assumption that you can earn 3 to 5% more than investment-grade bonds. Otherwise, why would you do it? So how likely is a 6 to 8% annual S&P? Now in 2014, the S&P without dividends grew by 11.39% and with dividends 13.69. Let's take a look at which direction these markets are really heading. Will it be a bull? Will it be a bear market? Or are these markets just going to go sideways? Now, if we look at the S&P over the last 30 years, my question would be, how many down years has the S&P with dividends had? First of all, looking at the last 10 years from 2005 to 2014, what would you say to that? How about the previous 10-year period from 95 to 2004? And last, the 10-year period prior, 1985 to 1994. Now, this is going to surprise you. In the last 10 years, only one. The previous 10-year period, 3. And between 85 and 94, again, only one down year. tremendous volatility every week, day, hour. But when you look at the calendar years, the number of down years that the S&P with dividends has had are very few. Complete disconnect between emotionally what everyone believes and the truth of the matter. So let's take a look at this chart. Again, in 2014, the S&P went up 13.69% with dividends. So if we look at this 10-year period, what we find is only one down year, 2008, the Great Recession, where the market dropped 37%. This means 90% of those years, the markets were up. Previous 10-year period, we had 3 down years. The dot-com bubble bursting in 2000, followed by the tragic event of 9/11 in 2001, and the aftermath. This is the only 3-year consecutive period since the Great Depression that the market went down in 3 consecutive years, as I said. This downdraft was almost 40%. So the frequency of this event, this 3-year event, which happens very rarely, created about as much damage as this 1-year catastrophic event in 2008. So looking at this 10-year period, the market was up 70% of the time. How about the 10-year period, 85 through 94? Only 1 down year when Saddam invades Kuwait. And although it was true that the Dow dropped 18% in the summer of 90, the S&P with dividends finished down only 3% on the year. 90% of that 10-year period, the market was up. So let's look at the average annual rate of return of the S&P with dividends over the last 10, 20, and 30-year period. What do we see? 9.48 over the last 10, 11.74 for the 20-year period ending December 31 of 14, and 12.84 going back 30 years. Now, of course, past performance is no guarantee of what the future holds, but it's important to keep this information in mind. Now, what would be interesting is, let's suppose we were able to invest in the S&P, and one way we were able to invest, let's just suppose, was the S&P couldn't go down in value when the market did. So, for example, let's just suppose that we were able to invest in something that guaranteed that when the market went down, you had a floor of 0%. So when the market dropped 37% in 08, you would actually lose nothing. But in exchange, when the market would go up, let's say in 09, like it did 26.46%, let's suppose you were capped at 12. So a growth floor of 0% and a growth ceiling of 12%. If that were true, if we looked at the last 10, 20, and 30-year period of time, you're going to see average annual rates of return between 7.75 and almost 8%. But no sleepless nights like we had here in this 3-year period or in 2008. A smoothing out of average annual rates of return. Last, what if we invested in the S&P where we took the growth of the S&P, multiplied it by 150% with a ceiling of 10. So if the S&P went up 5, you'd get 7.5. If the S&P went up 4, you'd get 6. But a ceiling of 10 and again a floor of 0. And what you see is the average 10, 20, and 30-year period hovers right around 7%. Now, how often, going all the way back to the 1930s, did the S&P increase in value? 40% during the Great Depression decade. World War II, the market couldn't possibly go up during that decade. The 50s, 80% of the time. The 60s, the 70s, the 80s, the 90s, 90% of the time. Worst decade of investing since the Great Depression, January 1, 2000 to 12/31/09, the market went up 60% of the time. So let's look at riding the market versus this type of an indexing strategy which offers
a growth floor, and a growth ceiling. So if we look at the lost decade, January 1, 2000 through 12/31/09, and if we actually started with $1 million and rode the market, its downs, its ups, we would have finished the decade on 12/31/09 with your million only being worth $908. Whereas if we adopted an indexing strategy to the market with a growth floor of 0 and a ceiling of 12, that million would have actually grown to $1.6 million, creating over a $724,000 difference in value. No sleepless nights of these down markets, but when the markets really roar, you get 12%. Look at this difference, though, very significant. We also tested this during the Great Depression decade of 1930 to 39, and again, starting with $1 million, looking at that first 3-year period from 1930 to 1932, our million would only be worth $390. But if we hung on to the end of the decade and didn't sell out, we almost came back to that original $1 million value. Now, following our approach with a 0% interest floor and a 12% ceiling, even during the Great Depression decade, the million would have grown to almost $1.6 million, creating almost a $600,000 difference in value. But when the market bottomed in 1932 at $390, we still would have been around our million. Now, everyone, this also doesn't take into account the costs of this type of strategy. We're not paying attention to taxes at this point. We're only showing you the example of raw returns. Now, when we think about the market, and this goes all the way back again for a number of years, you can see all the volatility represented by these dots. This is the down movement in the market during the year. The bar chart represents where the market actually finished. So the indexing strategy removes the downside, but smooths out the returns, taking away, again, your upside potential. You'll remember that the one thing we proved in the chart, that if you can stomach the ups and downs, the volatility of the S&P with dividends over time, it has created historically pretty exciting returns. The indexing strategy just minimizes volatility. So if we look at it over time and the percentage of every decade of when the markets went up, these numbers are obviously, I think, very surprising to most people. So the key questions, if you could capture between, let's say, 10 to 12% of all the up markets only, if down markets didn't affect you, and you could lock in those gains, guaranteed by some of the largest insurance companies in the U.S., if it all grew tax deferred, guaranteed under Internal Revenue Code Section 72E1, if distributions came out tax-free under 72E5C, and you had ready access to the cash, if you could have all of that, what percentage of your low to moderate risk portfolio and your annual savings would you allocate to such an asset class? And most people seem to indicate a pretty high percentage of not only their low to moderate risk portfolio, but annual savings. Now, why consider an indexed universal life policy to adopt this type of approach? Because we do get potentially tax-free growth. We get non-IRS reportable tax-free income when we pull the money out of the policy, an income tax-free death benefit. It's not subject to the new Medicare tax, and there's no required minimum distributions. We have flexible premiums, long-term growth potential, as I've described, and death benefit. This is a life insurance policy, and it offers substantial liquidity. So, with respect to retirement planning, if we think about how much capital you need at retirement, one of the ways to secure that future is by adopting an indexing strategy.